Hi, good afternoon. My name is Kathleen with Pristine Green Financial Solutions, and I'm here to go over what it means to be a first-time homebuyer and what are your options going forward. So let us go ahead and begin. So I'm going to go ahead and share my screen with you guys so you are able to see what your options are. So let's do it. First time home buyer workshop, your step-by-step guide to buying with clear confidence in this market. So again, my name is Kathleen with Pristine Green Financial Solutions, and I'm going to go ahead and give you a really quick walk on what it takes to buy something in today's market. So let's get started. So, what you will learn today, what you will really need to avoid costly mistakes, the step-by-step process, and how to get started today. So, whether you've been dreaming about owning a home for years or you just started exploring the idea, this workshop is designed to cut through the noise and give you a clear, actionable path, and by the end, you will know exactly what it takes to get started. So let's go ahead and dive in. So the truth about buying a home, most first-time home buyers, they will delay for years, not because they aren't ready, but because they believe that things are simply untrue. Let's bust the three biggest myths holding you back from purchasing your first home or from you re-entering the market. So I need 20% down. Not true. Many loan programs allow as little as 3% to 5% down. The truth is the 20% rule is outdated. It does help you, but in this market and in this climate, you do not need 20% down. We are going to talk about the different types of loan types that allow you to purchase your first home. There are programs like I mentioned that you can actually put as little as 3% down of the purchase price. The purchase price being the price that it will cost you to buy your home, whether it's a single family, whether it's a duplex, triplex, a manufactured home, a trailer home, you just need as little as 3% down in some scenarios. But the norm is 3.5% down for FHA loans. FHA are governmental loans that are backed by the government that is a lot easier for buyers to actually purchase homes. The next thing is rates are way too high. Waiting for the perfect rate cost can actually cost you time and equity. You can always refinance your home later, but you cannot get back the years that you lost on wealth building that you missed. So, when they say rates are high, there's a popular adage that says you buy the house, not the interest rate. You can actually buy a home right now, right this minute, and in 6 months from now, and in some cases, exactly 210 days later, you can refinance your mortgage to get a much desirable loan, a much desirable interest rate. So again, you marry the house, but you just date the interest rate. The next thing is I should wait. The longer that you wait, the more you will pay in rent and the more likely prices will rise. So waiting rarely works in your favor. Most people delay because of misinformation, and that's what the point of this buyer's workshop is for, so you understand what you are qualified for and you will understand what it takes, and it's not as hard as it seems. So let's continue. The next thing is why home ownership matters. Buying a home isn't just about having a place to live. It's one of the most powerful wealth building tools available to everyday Americans. Here's why making the move matters to your future. First off, you build your own equity. Every time you pay your mortgage, you build your net worth. Renting builds up your landlord's equity, not yours. Equity is money in your pocket when you are ready to sell or when you refinance. It controls stability and control. No more rent hikes or landlord decisions. Your home, your rules, your fixed monthly payments stays predictable for decades. So when you are renting, you are subject to the landlord renewing your rental amount at the end of the lease, And you sometimes, in some cases, you are not prepared for a rate hike, a rental hike. So you don't think about, oh, let me save my 3 months to move first, last, and security. So you're subject to whatever the landlord decides to have you pay. So when you own your own home, you are on a fixed mortgage for 30 years. So your mortgage amount stays the same every single month for the next 30 years or when you sell. The next thing that why home ownership matters is long-term financial growth. Historically, real estate appreciates over time. Homeowners build significantly more wealth than renters over a 30-year period. Think about that. So even if you have $2 to your account, you have the equity in your home. Let's say that your house is valued at $500,000 and you have a balance on your mortgage for $200,000. So that means your net worth is $300,000, even if you had $2 to your name versus the renter who has $2 to their name, but they don't have a home and they don't have the equity that you have. So this is one of the best ways to build generational wealth and financial growth. That leads me on to my next point, generational wealth. Homeownership is one of the most reliable paths to leaving something meaningful behind for your children and your family. So, in the event that something happens and you transition on to your next life, you have just left your home for your kids, which they can use as a generational wealth tool builder, whether they decide to keep it, rent it out, or keep it, refinance it, and take the equity out of it to buy another property or to fund a business. That is a generational tool that you left behind. So if you didn't leave an insurance policy, but you left the house, you still did a good thing for your kids. You've allowed them to have the access to the equity from the house that you left behind to fund business acquisitions or to allow them to acquire another investment property. So that is one of the best ways that you can leave for generational wealth for your kids and your family. Next up, what you actually need to buy. The good news is the bar for home ownership is a lot lower than most people think. You do not need perfect credit, a massive down payment, or a single salary. Here's what lenders actually look at and what's within most buyers' reach. Your credit score. Your credit score does not need to be perfect. Many programs accept scores as low as 580. And in the FHA loan that I told you about earlier, some lenders will allow you to have a 550 credit score in order to get a home. So again, you do not have to have a 700 credit score. You can go as low as 550, but the norm is 580 credit score in the middle. So your middle credit score has to be a 580 FICO. Verifiable income. So whether you are W-2, self-employed, 1099, part-time, or you have multiple income types to qualify, consistency is what really matters the most. Lenders will look at the last 2 years of income in the same industry. And if there are any gaps, they will ask you to explain it. But if the gaps are not that long and they are within reason, lenders will accept them. Another thing is your down payment. As I mentioned to you before, all you need is a little less 3% down on conventional loans or 3.5% on FHA loans. There are also down payment assistance programs that banks are actually funding to help you with your down payment. Some lenders have programs that are forgivable if you make a certain amount of monthly payments on time. Some lenders have down payment assistance grants in the form of FHA and conventional loans. And then some programs, they do require you to repay them. So homeownership is a lot easier and affordable and accessible. The next thing is you do need some savings. You do need reserves for closing costs and some initial expenses. Initial expenses like your inspection report. You want to know exactly if there's any repairs that need to be done on the home, or if there's any you also want to know if there's any repairs that need to be done, any foundational issues, electrical issues, plumbing issues. the inspection report will definitely convey that. You also will need initial expenses like your appraisal. You want to know how much the house is valued for, and the lender wants to make sure that the house is valued for the amount that you're asking them to lend you. And then as far as your closing costs, consist of your taxes and your insurance and your title fees. So, and prepaids. So those are things that you will definitely want to put money aside for, so there are no surprises. You don't need it to check every box perfectly. A good lender helps you build a plan to get there. And even if you're not quite ready yet, starting is half the battle. So let's continue into the process. Your loan options made simple. There's no one size fits all mortgage. The right loan depends on your credit profile, income, your savings, and your goals. Here's in plain English a breakdown of the most common options available to first-time home buyers or those re-entering the market. First up is your FHA loan, buyers with lower credit scores or limited savings. So if you have like a 580, 600 credit score, this loan is definitely for you. This is a great entry point into home ownership. Again, this is not requiring you to have a 700 credit score. You can start as low as 550 in some cases. Um, and if you have limited savings, FHA loans don't require you to have like a 6 months reserve in some of the other loans that we're going to discuss, but they do want you to have money to close, to be able to close. So again, FHA requires little as 3.5% down on your down payment with a credit score of 580 or more. It's again, some lenders will allow down to 550, and they are a lot more flexible on your debt to income ratio. What that means is the debt that is going out, like your credit card bills, your car notes, versus the income coming in from your employer or from your if you're self-employed, from your business. So again, the debt going out versus the income coming in, which is your debt to income ratio. Next up is your conventional loans. Conventional loans are for buyers with a stronger credit profile and stable income. So again, this is not a loan that is government backed. This typically requires 620 and above credit score. With 20% down, you do avoid paying mortgage insurance or private mortgage insurance, which is called PMI, which actually allows you to save money in the long term. These loans, again, they are not government backed. They typically are for people who have a higher credit profile, 680 and above. The higher your credit score, the lot favorable your interest rates will be. And if you put down more, 20% down or more, you do not have to pay private mortgage insurance. Those types of private mortgage insurance is in the event that your loan defaults. This protects the lender from if the home goes into foreclosure. It protects their asset. You also have special programs. These are good for buyers who need extra help with down payments and closing costs. So you have state, local, and nonprofit programs that offer low or zero down payment options, grants, or forgivable second loans. Many buyers don't know that these exist. So your local county government do offer these types of down payment assistance to help you with your meet your down payments if you do not have the full amount, 3.5% down. With those types of special programs, most of the time you do have to have that loan for 10 years. And if you refinance or sell, those loans do have to get paid back at closing to the government municipality that you received the down payment assistance from. So again, those type of programs, you have to stay in those homes for 10 years. Otherwise, the loan becomes repayable, whether or not you refinance or sell your homes. So the right loan isn't the most popular one. It's the one that fits your unique financial picture. And that's exactly what I'm here to help you figure out. Next up is how much can I afford? Forget the listing price for a minute. What truly matters is whether you can comfortably manage the monthly payment and understand every component that goes into it. So, your principal and interest is the core mortgage payment. what you owe on the loan itself. You split it between paying down the balance and covering the lender's interest. Next up is your property taxes. Usually it's collected monthly and held in escrow. It varies by location, and your lender will calculate this amount into your total monthly payment. Homeowners insurance, that is required for all lenders, for all property types, whether it's a condo, whether it's a single family home, a duplex, a multifamily, 5 to 8 unit multifamily, that if as long as a lender is lending you money to purchase a home, you need homeowners insurance. This is required again by all lenders. It protects the investment from damage, liability, loss, and also escrowed monthly. So when I mention that it protects the investment from damage, I'm located in Florida, so we are a flood state. So with those types of insurance, you will need flood insurance in the event that you live in a flood zone. So the golden rule is you date the rate and you marry the payment. Interest rates change. You can always refinance later, guys, but your monthly payment is your long-term commitment. This is what you're committed to in the long run. 30-year fixed, 30 years. So make sure it fits your lifestyle payment today. So a good rule of thumb is to keep your total housing payment at or below 28 to 30% of your gross monthly income. The home buying process simplified. Buying a home can feel a bit overwhelming. It is a lot. However, but when you break it down step by step, it's a clear and manageable journey. Here's exactly what happens from start to keys in hand. So you get approved by me. You know your budget and you strengthen your offer. So when you are getting approved, you're submitting your W-2s for the last 2 years. You are submitting your pay stubs. If you are someone who receives alimony, you receive Social Security, child support, those are income. As long as it's verifiable, you can include that in strengthening your credit profile, your pre-approval profile. We also check your credit history to see what your scores are, to see if you meet the minimal and that your debt to income ratio, what we talked about earlier, the debt going out versus the debt coming in is below a certain threshold. The threshold is between 43 to 50%. So you want to make sure that your debt going out and the income versus coming in is within those parameters. Now, once you get approved, you do get a pre-approval letter and you go out with your realtor, which I'm a realtor too, so I'm more than happy to help you. You go out and you find the home, you search, you tour homes with your agent, whether you are in Broward County, Miami-Dade, your agent or myself, we will go out with you and we will check these homes out. And from there, once you find something that meets that's within your budget, that meets your desires, the things that you are looking for, we move forward and we make an offer. So we go ahead and negotiate the terms and the conditions with the seller. We negotiate how much we're going to negotiate the purchase price. We're going to negotiate the amount of time that's given for us to close. So the time that's given us for us to close is the time that we need to go ahead and submit the loan. And then we're also going to negotiate the inspection period. The inspection period to see how much days from the time that the seller and yourself signs the contract to the time that till we actually go ahead and schedule the inspection to see any repairs or any issues that needs to be addressed prior to us moving forward. Now, once the inspection is done and we submit any issues to the seller and the seller agrees to pay for it, we then go ahead and move forward with the appraisal, submitting of the loan. Let me say that. Before I say that, we go ahead and we move forward with the submission of the loan. So once we submit the loan and we submit the loan and we get approved with the lender, we're now going to order the appraisal to make sure that the house is valued at what we offered initially and the seller accepted. Now, should the house not be accepted, should the house not meet the value, the seller has one of two things to do. The seller either has to reduce the purchase price to meet the appraised value, or the seller has to release you from that contract. So you can go on and continue your search. Now, let's say that the seller says, okay, I'm going to go ahead and reduce the purchase price and meet the appraised value. Now we go ahead and we move forward with the loan process, and the lender will give us conditions, approval conditions to satisfy before the lender gives us a clear to close to move forward with the keys in our hands. So that is something that I would go over with you on a one-on-one consultation. And then once you do meet those conditions that was set by the lender, we are now getting a clear to close, and we go ahead and buy our fancy outfit so we can take pictures for the gram, and then we move over to closing. Closing can be done virtually or in person, and once you do your closing, you can now sign your documentations, and you are now a homeowner, and you now get your keys. So again, we get approved. That's the first step. We find a home. The second step, we make an offer. The third step, we do our inspection, our loan submission, and our appraisal. Fourth step, and then we close and get our keys, and you have now just become a homeowner. Congratulations. So most buyers complete the process in 30 to 60 days once they get approved. And pre-approval is one of the most single important steps. It tells the seller that you are completely serious, and it also tells your real estate agent that you are very serious about purchasing and you're not just there to window shop. And it gives a clear budget to shop within. So one of the biggest mistakes to avoid is, even if you're motivated, well-intentioned buyers can derail their purchase by making avoidable errors. Here are the four most common mistakes we see and how easy it is to steer clear of each one of it. Waiting too long. As I mentioned to you before, every month that you wait, you're paying rent with zero return. Your home prices and your interest rates are not pausing because you're hesitating. It's climbing every single month that you're waiting. Next up, big purchases in the mid-process. New car, new credit card, new furniture, any large purchase during this buying process can change your debt to income ratio and jeopardize your loan approval. During this process, steer clear from buying a new car, even if there's a great sale at your local dealership. You want to steer clear of that. If you received a card in the mail from one of the biggest credit card companies that is offering you a low introductory rate, or they're giving you benefits, cash back, or travel perks, wait till after you close. You get your keys in your hand to apply for that credit card. New furniture. Even if you get a clear to close, steer clear. Do not buy any furniture just yet. Wait till you close and you have the keys in your hand to now buy that furniture. Even though the furniture store is offering you 24 months before you have to pay your first bill for your credit card on that new furniture. Wait. Do not skip the pre-approval process. Shopping without approval process wastes your time, weakens your offer, and it also sellers typically take buyers who are pre-approved a lot more seriously than if you don't. One of the first things that they will ask to accompany your offer is your pre-approval letter. So do not skip that process, because you don't want to waste your time, you don't want to waste your agent's time, and you don't want to waste the seller's time scheduling a showing for a property that you're not even approved for. And do not listen to wrong advice. Family and friends are have good intentions, but they can also cost you thousands of dollars. Work with qualified professionals like a trusted lender like myself, or a real estate agent like myself, who know today's market and who can actually give you factual data and give you sound advice and years of experience in this industry. So what is your next step now? Your next step is to get approved, which is a very fast process. It's a 15-minute process. It's just a submission of your last two W-2s, 1099s, tax returns, your pay stubs, your bank statements, and we pull credit. And that only takes 15 minutes. And doing that, you can schedule a consultation, whether it's in person or virtual. I can do virtual consultations anywhere in South Florida. And if you are looking to buy an investment, I can do virtual consultations from anyone from any state. And then ask your questions. There are no wrong questions. There are no stupid questions. There are no small questions. You are a first-time home buyer or you're someone re-entering the market, and the market has changed significantly when you last bought a home if you're re-entering the market. So it's definitely worth asking your questions to get clarity and to be confident in your purchase. My name is Kathleen Barreau with Pristine Green Financial Solutions. You can reach me at 786-253-0211. That's 786-253-0211. I am located in Miami, Florida, and I can help you if you're looking to buy your primary residence here. And if you're looking to lock in an investment property in other states, I can help you as well on the lending side. Again, my name is Kathleen Barreau for Pristine Green Financial Solutions for your mortgages. And then for your real estate, I am Kathleen Barreau for Pristine Green Realty. Thank you and for joining this first-time home buyers class. And I look forward to hearing from you soon. Thank you.